The gentleman's time has expired. The chair now recognizes the vice chair, Mr. Ross.
Thank you, Chairman. 33 years ago, my wife and I purchased our first home. We did it under FHA, and we put 5% down. And at the time, we also paid what I learned was called PMI, private mortgage insurance. And the reason we had to pay that is because unless we put 20% down and financed 80%, we had to have the guarantee in there just in case of a default. And it led me to believe then that I needed skin in the game, but more importantly, it also to this day shows me that there was capacity in the market from the private sector to take some of that risk. And I guess what we've seen over the last two panels that appeared before you in this topic is that a government backstop is absolutely necessary because apparently the private sector cannot accurately price or set aside reserves for a deep in the tail risk of severe turndown in the housing market. Is that something that each of you agrees with, Mr. Wallison? I mean, are we losing, is the private sector so inept that we can't allow them to have confidence in their pricing in the event we do another crash that we had in 08?
One of the reasons we had the crash in 08, the major reason we had the crash in 08, is that the government had driven up through its policies housing prices beyond the level where they made any economic sense because the government was buying those mortgages. And so, and of course, when we had the crash, the housing prices fell, and a lot of people, especially low-income people, lost their homes.
And to that end, let's assume that back then we had a viable private market of buying these mortgages. Would it not almost self-regulate because it wouldn't take the risk that was being purchased then by the GSEs?
One of the things that we have to understand, and what doesn't seem to be understood here, is that there's a trade-off between underwriting standards and housing prices. And if you reduce, say, down payments to a very low level, you increase the amount of debt that the homeowner takes on. When the homeowner takes on a lot of debt, not only does that homeowner become a riskier credit, but in addition, that drives up housing prices, and so fewer people can afford houses. So in other words, when we reduce underwriting standards, especially down payments, we make it harder for people to enter the home ownership system because housing prices have risen much faster than wages are rising. As a result, we are stuck at 64%. We could have a much more viable and a higher home ownership system in the United States if we allowed prices to go to a level that the private sector would produce, and that would be through using solid underwriting standards, including solid down payments.
Can I answer your question?
Please.
Basically, that's the kind of the heart of our proposal, because we look at the fact that there's two sets of investors. There's investors that will invest in credit risk, and investors interest rate risk.
Right.
And we're looking at, the proposal at Milken is, we'll backstop the investors that want interest rate risk because they need to have a commodity that they can trade to manage their interest rate risk. But our proposal is to let the private sector hold all the credit risk in the form of either the issuers holding the tail risk and the people holding the front. You mentioned PMI.
Right.
I think PMI is the natural in a future state where the PMI companies can take on, not only up to 20% down payment, but maybe let's go to even 70%. And that way the issuers are protected, but the government is simply stepping in to support the interest rate investors the same way the FDIC protects depositors.
Right.
Like depositors are protected by FDIC. FDIC does not guarantee the loans that are in the bank's portfolio.
And there's enough capacity waiting to do this, isn't there?
And that's exactly how Ginnie Mae works. Ginnie Mae does not guarantee any loans. We guarantee the issuer's ability
Right.
to handle their bond payments, and that's the heart of the Milken program initiative, is to say that we have hundreds of issuers, just like we have hundreds of banks, and they're able to all get interest rate protection in the capital markets, but the credit risk is held by the private sector.
Congressman,
Yeah, and Dr. Zanni, I want to go to you.
just to make clear, Mr. Tozer's proposal, though, has an explicit
Backstop.
catastrophic government backstop that's
Right.
payment. And that's the point. If you want
But you seem they can offload these credit risks with incentives to the private sector.
They can offload all of the risk except the catastrophic risk. You need a government
Kinda like what we do
backstop
with
to take
TRIA.
the catastrophic. And if you don't, then mortgage rates will be higher, and long-term fixed-rate loans,
How much
30-year
higher
loans,
would
15-year
you-
loans. will-
How much higher? Are we talking in terms of
For the
basis?
typical borrower, I'm just going back to the PATH Act. That was the last
Right.
attempt at this. So let's take that as our benchmark. That would have raised mortgage rates for the typical borrower by almost a full percentage point without that government backstop. Now, of course, there's a lot of other moving parts in PATH, and that could be mitigated. But that's what you're talking about, and that's the person in the middle, right? Not
But that's the elimination of a taxpayer bailout with that extra point.
that is, you have no government backstop. That's what you're giving up. And then if you did that, then